Just to give a little background too, as we get into this session, Trusted University, yeah, this was created by ITM and Life Insurance Trust Company, two of the leaders in life insurance and trust administration. ITM provides, if you're not aware, ILET administration and policy management, helping trustees stay compliant and efficient. And Life Insurance Trust Company is that first corporate trustee focused solely on ILETs. Offers deep expertise in trust management and regulation, and together through Trusted University share insights, best practices, and data-driven trends to help professionals like yourself deliver smarter, more effective, and trust planning and client services here. Now, my name is Aaron Hansen. You can go to the next slide. I'm the Director of Remediation with ITM. I may have worked with you in the past. And most importantly, I want to welcome our special guest speaker, Tate Groom. Now, Tate joined Colton Groom Insurance Advisors in 2003, and he is now the co-CEO and Director of Insurance Strategies, a certified financial planner, chartered life underwriter, and an advanced estate planning designee. Tate has more than 20 years experience providing trusted life, disability, and long-term care insurance solutions to individuals, trustees, and advisors like yourself. He's earned a Bachelor's of Arts degree in Communication Studies in Spanish from UNC Chapel Hill in 01. And prior to joining Colton Groom, Tate taught elementary education for at-risk youth, and since then authored his first book, The Best Policy, Managing Irrevocable Life Insurance Trusts, and was nominated by Life Health Pro as one of the top 20 most creative people in insurance, and was recently recognized by Forbes, ranking him as number 27 top financial security professional in the United States. Now, before we get over to Tate and let him take the reins here, you can go to the next slide. I just want to touch on a few housekeeping items. There'll be a post-event survey. Thank you in advance for completing it. It's a brief survey. Today's session is going to be approximately 50 minutes. We're going to leave time, if we can, at the end of the session here for questions. So do submit any questions in the portal. And if we do run out of time, don't worry, Tate or myself will follow up with you after this session wraps up. Also to note, today's webinar is being recorded, and you will receive a link within 24 hours that includes instructions for the certification of completion. So from here, Tate, I'm going to hand over to you to take control.
Yeah, well, thank you guys, and thanks everyone for being on here. It's so good to see, especially some of the names of a lot of my former Life Trust 3D clients, and I just want to thank Aaron and the ITM team for taking such good care of all the clients that I got to know over my 10 years of kind of being in the policy management space, and I've just been really excited to be focused on kind of the insurance design and ongoing management still for family offices and things across the country. So thank you for having me, and I've enjoyed a really nice relationship with ITM, especially through that transition. And so today we'll talk about the end of term insurance and why it matters. Next slide, please. We think about term insurance as being the most simple, the easiest type of life insurance policy. I think is as an ILET trustee, probably ITM loves when they have a term policy. The number of if, ands, or buts are not quite as plentiful as some of the other types of policies. So, but term is a way that I think advisors, trustees can provide value. Relationship managers can provide value to the client. You do not have to be an expert in life insurance to understand when the term policy ends, and just to ask the really pertinent and important questions to your clients, because I can pretty much tell you that the agent has not likely been in touch with the client. This is a place for you to provide value. And so hopefully today it's not just about learning about life insurance and term, but how can you take what you learned today and apply it in your everyday practice. So our agenda is going to be just being very thoughtful about the termination of a term policy. What can you do, but not letting that date creep up on you without really getting in front of it, and having that good client relationship with the client, good proactive communication. We're going to talk about, yes, you can convert a portion or all of the term insurance. Some people think you don't have to convert the entire $10 million amount. You do not have to do that. We'll talk about that. Term conversion options vary incredibly much from carrier to carrier, and even certain insurance companies have issued term policies within. So John Hancock might have different conversion language based upon when you purchase that policy, and ITM does a great job of helping you understand what the conversion language is based on the type of term policy you have. Securing new term insurance. So again, at the end of a term period, what are you going to advise your clients to do, or what do they need to do? Can you buy new term insurance? Do you need to look at conversion? Do you need a permanent form of insurance? Or last bullet, or there is something, and most of you are familiar with a life settlement. And what we just don't want to have happen is a term policy to end, especially if it's convertible and the insureds are, older, older meaning 65, 70 or older. If it's still convertible, there may be a way to sell the policy via a life settlement and recoup, some of the premiums they've paid in over a long period of time, or maybe even more, depending on their health. So Aaron will talk a little bit more about that next slide as we get further into the presentation. So I just want to really quickly define what I mean by when a term policy ends. And what I say is what it really means is that the scheduled premium, the level premium term period, it ends. And we're going to talk about level premium term today. There are premiums like increasing premium term policies, especially with some of your mutual companies. We do not touch on that a whole lot today. So if you have questions on those, make sure you ask Aaron, or you can feel free to shoot me a note. But we're going to talk about level premium term policies mostly today. So there's kind of three general outcomes. Number one, the premium can increase. So you have $1 million death benefit and you're paying $1,000 a year, and then all of a sudden the premium skyrockets. This is important to understand because especially if your client is paying on automatic billed premiums, so EFT, maybe they're paying monthly via monthly bank draft, maybe they're doing an annual draft. The insurance company will continue to draft that premium. So you need to be very, very thoughtful, especially if it's paid monthly. Your client will call and say, why did my premium go from $300 a month to $3,000? And that's no exaggeration. They do jump that high. So again, being proactive. Or a death benefit could decrease. The insurance premium may look similar to the previous premium, but the death benefit would have decreased significantly. Next slide. Or the policy might just end. So here's an example of a premium increase. And this is a $1 million death benefit, 46 years old. I think somebody chose my exact same age. So this is me buying $1 million term policy. I just need it for 10 years. $758. If you as my trustee or my relationship manager don't tell me when I'm 55 years old, I will forget that I bought $1 million 10-year level premium term period. We always forget what we buy. And I need you to tell me that my premium will jump from $758 per year to $15,370, or I'm not going to be very happy with you. So make sure, and I know ITM does this. When we used to run Life Trust 3D, we would start at about 3 years. Every year we would ping folks to say, hey, this is coming to its end. This is coming to its end. So really make sure you're reading the ITM reports. I know term insurance is one that's easy to gloss over, but again, there's a lot of value that you can provide by just being proactive in your communication. No one wants a surprise. If you can be in front of it, you can be the hero for the client, and that's what we want to talk about today. Next slide. The other example is, and this is usually if you've got a Lincoln, I know I'm not really supposed to talk about insurance companies, but I want you all just to kind of put some reference points. Lincoln National, I know they do this. The premium might be $704, $705 a year for $1 million, but Lincoln might, instead of saying your premium is going to increase, and other companies do this, they're just the first one that come to mind. they're going to make the premium look kind of similar to where it was before, but instead of $1 million death benefit, the death benefit will decrease to $50,000. I just want to reiterate, each contract is so different. Not all Lincoln term policies act this way. Some do. So you can't necessarily infer that just because Lincoln's term language from another policy that it's going to be the same, for the one you're looking at. And again, that's why you've got ITM as a resource. Next slide. So what if you don't take action? Well, I think the number one thing that we've already talked about is your client could be disappointed. I would not rely on the insurance agent to bring this up. Some insurance agents do a great job, but even in the higher net worth space, we find, kind of old statistics that 60 to 70% of all policies have been orphaned. The agent is retired, the account has been passed back to the house, back to the insurance company. So really do feel like that the trustee, the relationship manager, the investment advisor really should mark this kind of as an action item on your planning schedule. But you can really have eroded kind of the economic value. You've been so your client's been making gifts to a trust, and without any, just inaction, then, are those gifts, have they been wasted? You might have to increase gifts necessary to cover higher premiums. Let's say you do want to convert a policy. Say that, or the premium increases and you're willing to, maybe someone's sick and you're willing to pay for another 12 months of coverage, even at a much higher premium amount. You've got to plan in advance to make sure the gift, you've got adequate gifting capacity and can raise the cash to make those higher premium payments. Again, getting ahead of this thing before it happens. What if you had unexpected loss of coverage? This one with potential, especially if someone's health changes. We see this so many times. People wait until it's too late to buy life insurance. Their term policy lapses. They're not organized. They don't have the right advisory team around them. Their term policy ends and they have a serious health issue and they cannot get term life insurance anymore, or any type of life insurance. That's probably the biggest risk of overlooking this, having the policy lapse and you can't get it back. You cannot get it reinstated. And again, client dissatisfaction with communication, and it just might jeopardize the broader client relationships. On the inverse of this, if you're proactive, you really can solidify client relationships because no one's paying attention to this. And just again, fiduciary exposure. If this lapses on your watch, what are the trust beneficiaries going to say? Especially if mom or dad are sick, mom or dad pass away. We just want to really make sure that does not happen, on your watch. Next slide.
All right. Hey, thanks, Tate. That was a great summary there when you were talking about the death benefit decline example. Those are, from our experience, are less common than the premium increase. I think the premium increase, and you'd probably see, is most often what occurs. But we've had several cases to talk about what can happen where a policy or a trust comes on and it isn't known that the death benefit is no longer $1 million. The previous trustee missed that premium or that level duration change, and they paid the premium and thought everything was fine, and we're in year 11 or 12, and our annual reports are being created. They say, hey, it's not $1 million death benefits now, it's 50,000. That's a big issue. And the other thing to add in there, the Northwestern Mutual comes to mind with just the outright termination, meaning that maybe it's only for 10 years and there isn't a premium increase. It's literally that policy's done, which can be unknown, especially if client wasn't paying attention when they bought the policy. So a lot of things there. But when we look at just our managed process overall within ITM, being proactive is number one, especially on the remediation side. That's something that we emphasize, is really digging in, and we have specific logic and we have our processes all built around each policy type. because everything, each policy type has those different features and alarms, so to speak. But with the term policy, as soon as it's in our system, we're looking. We set up those triggers to look at that level period, that conversion deadline, and just the ongoing monitoring there. And each year we have those annual reviews that go out that include those details. And you'd mentioned that 3-year kind of alarm or trigger. We follow similar at that 3-year mark. The grading changes. Information starts to go out to the client referencing the upcoming conversion deadline and level period deadline. What's going to happen? Is it a premium increase? Is it a death benefit decrease? Does the policy just end? What are your options there? And then documenting that trust file. And just to add in a bit too, when we talk about the percentage of what of our policy types, what of our total death benefit that we specifically manage is related to term insurance. And to give you an idea of the roughly 37 billion of death benefits that we manage, term represents about 13.5% of that, roughly 5 billion. So when you talk about the risk that's associated with term policies, we haven't even dug into necessarily the sensitivity of the premiums and the tracking. It really shows you the amount of risk and things that can occur within a term policy. So just to briefly highlight that. But, maximizing the value of the trust, minimizing liability, all that goes into the proactive in the systems that you have in place. So I'll hand that back over to you here, Tate.
Yeah. No, I just think that's really, really good, Aaron. And I think, term insurance, if you're a trust administrator, especially, each bank and trust company has a different process for receiving the ITM reports. If you are a trust administrator receiving these, this is a place you can provide value. You see the 3 years on the term remaining. Don't just say that that's okay. Make sure that the relationship manager is aware. And that's a really good place for a trust administrator to really provide value to the trust company, especially when you're looking to grow and kind of become more, enhance your personal careers. And term insurance, a lot of times too, are larger death benefits. Maybe we need a $10 million, $20 million term policy for a 10-year time horizon. It's very rare that if you need that kind of coverage at the end of 10 years, you just don't need any term insurance anymore. So again, staying on top of this, being very, very thoughtful as kind of the end of the term kind of comes to a conclusion. And so we just want to talk about a better approach than the industry has kind of done in the past, and really understand what your policy does, your term roadmap. And again, do not think that all term policies are created equally, because if you do, you are going to be wrong. And I hate to tell you that, but you will. Choices are made knowing kind of the pros and cons or ramifications, one way or another. And, we want to make sure that you understand these choices before the end of the level term period. And one other thing before we move on is that the conversion period, the conversion window, may not be the same as the term length. If you buy a 20-year, we'll talk about this. If you buy a 20-year term policy, it may only be convertible for 7 of the 20 years, or 10 of the 20 years, or 15 of the 20 years. Every single one of these can be different, even with the same insurer. So that's what we'll get into. Next slide, please. So if your eyes aren't crossed right now, then you get a gold star. So I'm going to go into, and this slideshow is available after the presentation today, so you can kind of keep this roadmap for you. So I'll talk through it. We can't get through every conceivable option or scenario with this, but this will kind of give you an idea. If I start over to the left, is coverage still desired? This is a number one question to really ask. Does your client still need coverage? The other questions are, and I'll give these to you later in the presentation, but If so, then for what duration? How much is needed, and then for what coverage duration? Well, let's say that we're at the end of the term. No one thought about this before the term policy was issued. We're getting to the end of it. So if they say, no, I do not need life insurance anymore, and I'll tell you this is what my dad told me, and I think that everyone on this call can probably nod your head. No one ever objects to having life insurance. They only object to paying for it. So everyone likes to have a little bit of life insurance. They just don't like paying for it. So at the end of the term period, they say, no, I don't want it. I don't want to pay for it. The question to then ask, and ITM will be able to help you with this, is the policy still convertible? So if no, then your policy is going to end, it's going to terminate and pretty much be done. If it is, you still have options. If they are a little bit older and or have experienced a decline in health, let's say they're issued at a preferred non-smoker, they're 68 years old, and they have some adverse health things going on. You do want to explore the option of potentially converting the term policy. Converting it means getting it to a permanent type of insurance and possibly selling it via life settlement, so that you can help your clients maximize, and this is what we always talk about, maximize the benefits for the trust beneficiaries. Again, not letting the policy lapse, even if they say they don't want it anymore. Is there anything else that can be done? So if the answer is yes, they do still want coverage, well, now we go down to this whole other slew of options over to the right. The number one thing is how much coverage do we want, and how long do we need it? Do we need it for another 10 years, or do we need it for lifetime, or to age 90? And a lot of times that has to do with whether this is for estate planning purposes and legacy planning purposes, or if it is to cover a specific obligation. Right now we're working on a gentleman that's 76 years old that is waiting to sell a business and has a divorce agreement that says, hey, I have to have this term insurance. I have to have insurance until my business sells, and other policies ending, and that's not convertible, and we have to go buy new term insurance, a very significant amount, at an older age. And so, that is why one still might need term insurance when even at an older age. And that is, we're seeing that with people working longer, continuing to run their businesses. Even at age 65, they're still having fun in business. They're expanding their business, and maybe the business owner's name is attached for any creditors or any bank holder liens. And so need to make sure that the term insurance exists if there's still debt, maybe to a business owner. So those are some reasons why you may want to continue coverage even after the term period is over. If they're in good health, well, you can explore new options. If their health has changed, you really want to hope that term policy is A, with a really solid insurer, B, has favorably priced conversion options. And that's going to be your best bet. If they're not convertible, then you have to explore new coverage options. The best case scenario is that you have a really good insurer that has favorable conversion language and conversion to any and all products that they make available. So I'll just kind of pause there for a minute. If you have any questions, feel free to kind of put it in the chat. We'll take all questions kind of towards the end. All right, next slide. So it is okay to end a term policy, and that is coming from the life insurance folks. Like, it is okay. Sometimes I was talking to a gentleman today, had a lot of life insurance while his family was young. He's worked really hard, saved a lot of money, and his kids are graduated, mortgage is paid off, they live a modest lifestyle, and the term insurance he had, it served its purpose. So he did say, though, he had $5 million of insurance. He said, well, I just kind of want to keep $1 million of it. How much does it cost to convert $1 million of it to permanent? And that's a very thoughtful question. But it's okay to end a term policy. It's okay to, if you're not willing to fund the higher premiums, because term premiums are really cost effective and permanent life insurance premiums are high. They're much higher than the term. So maybe it runs into gift tax burden. You're having to make a decision whether you want to do annual gifting or fund a grandchild's 529 plan or pay a conversion life insurance premium. Like, we get it. Sometimes it's nicer to pay the grandchildren's 529 education than to buy, to do a life insurance premium. We understand. So sometimes if you are the trustee, you think that this person needs to, look into continuing their life insurance, but I know not all grantors and trust beneficiaries are the easiest to work with. So sometimes the lack of cooperation and exploring options, you might, you can lead them to water, but you can't make them drink. So you might know what you think is best, but you can't force anyone to take action. So sometimes policies will end. And in that situation, in any of these situations, it is important to document the decision, document the communication, not just with the grantors, but with the trust beneficiaries. And I think that that's something that I've learned over my career. And there are template letters available. I bet ITM has some available. And there are banks, as banks and trust companies, when the policy's ending, make sure those trust beneficiaries know, and the communication and the file documentation is made. Next slide. All right, so term conversions. So a term conversion, it's a contractual right to convert all or a portion of your term insurance policy to a permanent policy without having to go through new underwriting. So you get to use your original underwriting risk classification from years ago, like back when we were all young and healthy, at super preferred non-smoker, you get to maintain that in your conversion, even though it might be 10, 15, 20 years older. Okay, so that's really, really important. This provision, it protects your future insurability should you have a decline in health. So a lot of times in planning, we say, hey, let's buy term insurance now to lock in your insurability. If you ever hear that, that is what the insurance advisor is trying to get your client to do, is lock in their his or her insurability. However, the rules outlined in the contract as to what your provision is varies from kind of contract to contract. So next slide, please. So a partial term conversion, just understand that if you get to the end of a term period, and just like my friend I was on the phone with earlier today, has $5 million of life insurance, says, I really only need $1 million going forward. You do not have to convert all of the existing term policy. And that's important to understand. If there's a need for it to be in two separate policies, you can convert one, maybe to $3 million term policy for a certain situation. And then you can convert another to a $7 million term policy to satisfy a certain situation or obligation or planning goal. So just know that you do need to be cognizant of ownership and any ownership changes, the tax implications there. But do know that a term policy, so you could convert 3 million and drop the other 7. Just know there's flexibility if you have the right term insurance company and you have the right language. And that's what we'll get into now. Next slide, please. So term conversion options that can convert to any available product. This is the rarest and the very best version. It contractually allows you to convert to any product offered for sale by the insurer. And I will say right now, and this is not an exhaustive list, but like Prudential is the first one that comes to mind for me. There are also companies that allow this. There are also companies that have a guaranteed conversion right, like Securian or Minnesota Life, conversion extension rider that guarantees this language. So just really understand that when you're buying term insurance or helping your client secure new term insurance, make sure if there's a possibility that it needs to be converted in the future, and you'll see in a minute, there's not much cost differential about getting the good stuff, the good term versus the less expensive stuff that is not convertible in the future. It's really not that much more expensive. The other kind of definition is any product made available for conversion at the time. Well, that sounds pretty good, but you'll see here in a minute, one of our companies changed the language. This was their conversion privilege. You used to have access to all their insurance products, and then they came out with what they call their conversion universal life product. Well, it's not priced well. You're going to see that in a minute. So the administrative practice by the insurer can allow them to make changes to the contract language as to which product the term policy is convertible to. So let's be thoughtful about that. If you ever have any questions on that and you want to just reach out, let me know. I'm happy to just shoot me an email. I'm happy to help you through that, so that kind of stuff. All right, next slide, please. So this actually happened last year, and I'm not picking on Lincoln, so I'm sorry, Lincoln, if anybody's on the phone from Lincoln, but man, last year we had a block of policies with Lincoln National, not Benefit Life, but Lincoln National, and this really is age 65-year-old male, $1 million death benefit. They essentially said, hey, we're exercising our right to change our conversion language. You have a window, and they, to their credit, they gave us about a 6-month window to say, hey, if anybody with Lincoln wants to convert, do it now. You have access to all of our product portfolio, but we're exercising our right. And they gave us a good window. So I have to give them, kudos for that. But to only use their conversion UL. And so we ran this for a 65-year-old that was thinking of converting. The premium before this new contract came into effect was about $27,500 per year for $1 million for lifetime pay. After they changed the product that you could convert to, it jumped up to $41,000 per year for the same $1 million. So within 6-month time frame, this company changed their pricing on their conversion, and they went from $27,000 a year to $41,000. It was 6 months, but that was that window. So I just really pay attention here. That this is nuanced, and make sure to your insurance agent is you're asking the right questions, and no one glosses over this kind of thing. Next slide, please. This is another example. Some other insurers that have only conversion to one product. Some companies, Bright House or MetLife is one. Transamerica is one to keep in mind. The old ING Voya, Reliastar, that's another one to keep in mind. There are others, but those are, I think Banner is one. Those are the ones that just come to mind that allow you to convert to one single product in their portfolio. And many times, so stay with me here on this slide, many times you are converting those at a very expensive rate class because they know you're being pooled with all the unhealthy people. If you're going to convert their product, they know that you can't go outside and go secure insurance independently because of some health issue. So a lot of times they say this product is going to be priced on a table D as in dog rate class. So if you know about life insurance underwriting classifications, you got super preferred is the very best, the least expensive, preferred. Then there's sometimes a standard plus, then a standard is kind of average, standard non-smoking, and then you have tobacco rates too, but just stay with me on this. Then you have table A, B, C, and D. And it's not like you got an A on your report card or a B on your report card. It's actually substandard rates. And so they're adding an additional premium if you get an A, a B, a C, and D is more expensive. So all of that to say is that on the red, this is a contract that restricts the conversion, and this is at a preferred rate. So you are underwritten at Transamerica, Aaron, as a preferred non-smoker. You need to convert your policy. Your premium is going to be, I know you're not 65 years old, it's going to be $41,000 per year. If you can go out in the marketplace and get underwritten even at a table B as in boy rate, so that's substandard 2 rate classes, we could find you something for $32,000 a year. Okay, if you remember my previous example, that was really should be, if you got decent underwriting, you know, anywhere from $25,000 to $30,000 per year. So what these insurers are doing is putting you in a high risk pool and saying, hey, I know you can't go and get insurance other places, otherwise you wouldn't be converting into our product, or your advisor is just not taking you through the education and the proper channels and spending the time with you to make sure you get the kind of the best insurance bang for your premium dollar. So that's a lot. I hope you're taking notes. But if you are healthy, or some people, you know, you want to shop around and try to find the very best contract. And a lot of times I'm going to say that you can do that on an informal basis. We've got a private underwriting process that we'll take clients through to kind of shop it around on a private and confidential basis without having to submit a formal application to, you know, a certain insurance company. And a lot of times that's a way to see if you can get something better than kind of the bird in hand you have. And then the last thing I'll say about this slide is, if the coverage is needed, and if you have to pay $41,000 instead of $32,000, and maybe the reason that you stay in that product is because your client's health has changed, that's still going to be a good outcome for the family. And so even if it's at a high price, you know, you pay that in for 10 years, it's $441,000 times 10 years, 400-some thousand for $1 million payout. You just run the numbers for your client and try to make the best decision possible at that point. So, all right, next slide, please. So again, term conversion periods, they do vary widely. So there is non-convertible term. It is available. Don't ever call my office and say you want non-convertible term, because I will say go to the internet. I do not sell, we will not place non-convertible term insurance to my office, because I believe in conversion. Even if someone never thinks they're gonna need it, we always try to build in flexibility into any type of insurance contract that we help put in front of a client or a trustee. So the single window options, sometimes that it's your contract's going to say it's convertible for the lesser of the level premium term period, or to a certain age, so maybe 10 years or age 70, or 5 years or age 70, for example. So just be cognizant of that. Always ask what the conversion privilege is. Or it's convertible for the first 7 years, and this is happening to any product, and then it's only convertible after that to the one specific product. The conversion product, again, if it's a conversion product, just think high priced, substandard rates, expensive. So these insurers are giving you kind of a short window to stay competitive, but really trying to say, hey, they're trying to protect against their tail risk about getting a very unhealthy population in year 18 of a 20-year term, and everyone converting to at a preferred rate to like their very best product chassis available. So that's how the insurers are trying to protect kind of their tail risk. Next slide, please. So kind of going through little kind of piggybacking on the last slide, but multiple window options even within the same term policy. So, convertible to any product for the first number of years, then a product made available for conversion thereafter. So again, kind of like I was saying, the first 7 years, it's any product, and then thereafter. There's another type of contract that's convertible to any product for the first 3 years, then convertible to a product made available for conversion years 4 to 7, and then not convertible after year 7. Like, that's pretty complicated. That's hard even for ITM to track. That's hard even for cold group insurance advisors to track. And we do this every single day, all day. But someone at ITM or someone in my office has to go through and make sure we write our analytics very specific to that particular contract. And so I would say, and we'll see some pricing in a minute, it doesn't cost much more to get the good stuff. So pay up just a little bit and don't get caught in these conversion windows that just, they might seem cheap, the cheapest if you run all the, they call it vital term. If you run it on the term comparison spreadsheet, don't buy the cheapest one. It's going to backfire. It's going to backfire. So next slide, please. So here's kind of the pricing. So it really doesn't cost that much more. Age 45, $1 million, preferred non-smoker, male. So regular conversion premium, these insure A, B, and C. That's kind of the cost. If you want to pay up for the extended conversion period, then instead of $700 a year, it's $760 a year. That is something just to understand. So companies like Security in Minnesota Life, Principal does this. They ask you to, they give you a base contract, and then you can add this extended conversion period on it for a little bit additional premium. So go ahead and add that. You won't be sorry. And I think as a trustee, it's prudent just to add that flexibility in case things change in the future. Next slide. So securing new insurance. Underwriting, health underwriting has evolved. So if you buy a new policy, you do have to be underwritten. There are some new streamlined processes that do make it easier. AI, we talk a lot about AI in all of our industries, but with a prescription check, a motor vehicle report check, they can do a lot of research, insurers can, on a client prior to even submitting. And so we can get electronic submissions, medical records pretty quickly. And sometimes for smaller face amounts, really like 3 million and under, sometimes you don't even have to have a nurse come visit you and do a nursing exam. Every situation is different. Every insurer is different, but there are ways to, especially to fast track underwriting. The other thing is if your client goes to like a concierge physician and they have, full labs every year, every 6 months, there are certain companies where we get to use the concierge labs for the permanent insurance. We're doing one right now with John Hancock. Our guy just went and had a full physical. All the blood work was taken in John Hancock. He needs permanent insurance for his family. He needs $4 million at 62 years old. They're going to use his lab work and his write-up and medical exam he just did for his labs for his doctor. So, part of what we have to do together as a team is figure out how do we make securing insurance for your client the least intrusive it possibly can. They may say, yeah, I want to do this, but then they think about having to get on a treadmill in the old days or have the nurse come and, all these things. And, it has gotten easier to procure new insurance. And if we have a really good conversation in advance, a lot of times that streamlined process can make it super easy on the client. So let's see here. Older ages. People are buying insurance for older ages more and more. I would say that, and we've got somewhat healthier older population than we have before. So if there's a reason and a need for life insurance, then we can again go through an informal process just to see if that person is insurable and what options might exist. So next slide, please. Aaron, take this.
Yeah, and on the, just circling back to the convert and sell, when we talk about the term policies and life settlements, it really is one of the least understood options. Life settlement in general is often not really an understood option. Term conversions to life settlements is a step below that. Even less people are aware. But it's common for an unwanted term policy, like you mentioned, at the end of a level period, for it to be allowed to expire. Of course, for this to be an option, the conversion date must still be there, that conversion option. So that needs to be monitored. And then other items that come into play on this are the carrier, the products available, are they a desirable or a well-priced product, um, along with the insured's age, the insured's health, any health issues. So there's a lot that goes into it for it to be the right situation. But the only way that you're going to know is if you look into it, request a preliminary evaluation, uh, talk to the insured, to the family about the option. When we talk about maximizing the value of the trust, this fits into that box. When you're looking at if that trust only holds a term policy, it's going to go from potentially whatever that death benefit is, a million, 10 million, to zero. And I would think that the beneficiaries, and in most cases, the beneficiaries would prefer there be something there versus nothing. So be sure to check that box, or reach out to your life insurance expert, or Tate or an ITM to help you with that. Next slide. And in closing, as we look to wrap up the session, which has been great, appreciate Tate, and I'll hand this over to him in a second, but really just want to reiterate the term policies. While we know they don't represent a majority of the policies that you manage, you don't know what to do, or you know what to look for. And just to reiterate, understanding the policy, looking at that specific level, term, duration, conversion option, what happens after it's done, memorializing the expectation, the outcomes, making sure that everybody's aware, reviewing annually. Don't let anything fall through the cracks, so to speak, and really looking ahead and anticipating what's going to happen and keeping those lines of communication open. So, Tate, I want to hand this over to you to wrap up.
Yeah, and I'll just thank you, Aaron. That's super great. And I want to challenge folks out there that, especially if you're younger in the trust career, is this is a play. Don't shy away from life insurance and ILETs. It's a place many times that trust professionals that this is not the most fun thing always to work on. We've got a lady in our office that is now she's our COO, and I asked her, so she was interviewed how she rose so quickly in our company, and she said, I was willing to do the things that no one else really wanted to do, and really take ownership of it, and it made a huge impact on our organization. And she is now she rose really, really quickly. She's at Trust Advisors Forum. If you're ever there, we'll see you there. So don't shy away from this. You don't have to be an insurance expert, but if you can ask questions, then you can be great at this portion of it. And so ask the question, why did you purchase this term policy in the first place? You will be surprised at the answers you get. You are going to understand where this person came from and why they bought the policy. Well, then you can say, well, is there still a need for life insurance? Do you still have a need, or do you have a desire to keep it? You may not, and this is really thing, you may not need it, but do you want to have it, and can you afford to pay for it? Maybe there are already monies in a spousal lifetime access trust or some other funded irrevocable trust, and do you want to maintain the policy? And if so, there are ways to do it. And do you want to understand your options? If you can ask those three questions, then I think that will help you kind of be an expert. And then if they say, yeah, I want to understand my options, well, you have resources. You can learn about it, and just make sure that you kind of you take this and you can run with it. I think anybody can do that. So, as we wrap up, next slide, we had a few questions that had come in already before the session started, and I don't know if there have been any others since then. I can go ahead and take the first one while we're waiting on other questions to come in. So the first question was, when is it time exactly to convert policies, and what policies are convertible? So trust, irrevocable, or revocable. So I think ownership, when you're talking about trust, irrevocable, or revocable, that doesn't factor into whether a policy is convertible or not, or when it needs to be convertible. So I would, how I think about it, is take ownership off the table for a second and see what the need is and what the duration of the need is. And I will always say, people are going to say, well, you're an insurance guy. Of course you're going to say that, but I can run the numbers. If you've got 5 years left on a term policy, I had this conversation this morning. I can run the numbers today and say at age 45, your premium, if you want to pay, your premium is going to be less if you start now versus in 5 years. But if I go all the way out to age 85 and I run all the fancy math, it's going to be pretty much break even as to whether you start now, because it's going to be more expensive in 5 years, but it's not going to be that much more expensive where if you run out 85 to 90, you're going to have saved all this money. But I'll tell you this, so when exactly is the right time? The time is when your client has the need. Because what I can't guarantee is, even if I can run all these numbers, let's say it's break even, the cost of waiting, if you will, is not exorbitant. It's I can't guarantee that the products that are available now are going to be available in 5 years. And what you'll see in our industry is companies, especially if you want guaranteed contracts, if you want a guaranteed premium and a guaranteed death benefit, which I know when ITM gets those reviews, they like it. And I know as trustee, when I used to my trust companies, when we used to run our reports for Life Trust 3D, I know for a fact that you all love your guaranteed premiums, no lapse guarantee, because you know if your client pays a premium, they have a guaranteed death benefit. All you have to worry about is whether they pay it on time or not. We have fewer and fewer guaranteed contracts available by the insurers. So your risk is not necessarily on my of paying paying more premium. It is, are the products going to be available that we have today in 5 years, and are they going to be priced as cost effectively as they are today? So that would be my answer there. When I reached, yeah, do you want to take that one, right? Age 97, or do we have any other
I haven't seen any. I think we do have one in here, but let's look at, I know on this question here, when I reach 97, if that happens, what do I need to do ahead of time to make sure my children receive what we have saved? I think, well, we were talking about term insurance today. This generally wouldn't apply in this situation with that age. Really comes down to how the policy's been funded and what happens at maturity and what maturity age is. We have on our side a small amount of policies that have a maturity of, say, age 90 or 95. Those really can cause issues, especially as you age, and you may see that as well. But if in case you have a policy, let's just say in maturity of age 100, what's going to happen? Meaning that if it's a whole life policy, it may be that it pays out the cash value at maturity. If it's a universal life, it may be that there is nothing that happens at maturity except that the policy pays out the cash value, which can be minimal, or you can have a full death benefit extension. So it really depends on the policy type. So if you're asking this question, you really need to look at that policy and figure out, what maturity is, what happens, what you've paid in, and any changes that you need to make. Hopefully, you still have time to do that.
Do we have other questions?
Yeah, a question came in. If the trust is an ILET, what is the process for determining the trustee's fee? I know on the ITM side, we have a set fee schedule for ILETs that come over. We've seen many trustees will add additional fees based on the number of policies, or they may base their fee on the size of the policy, but it varies from trustee to trustee. I don't know if you've experienced anything different, Tate, on your end.
No, I think an individual trustee may charge 0 to 1,000 or 750. I would say most trust companies start at a minimum of $1,000 and go up from there. I've seen them as high as 5,000 to start. So it just depends on who you're working with. I do think that paying a corporate trustee is worth every penny of it. And so making sure you find the right match of a corporate trustee to your situation is important. But I very, very much support corporate trustees. An individual is not going to do you might save a little bit on your fees, but an individual is not going to do the reporting that you need to make sure that policy works.
All right. Well, again, I appreciate everybody's time. Again, thank you, Tate, for joining us in this session today. But if anybody comes up with a question after this session ends, do reach out, and we'll be happy to assist you there. So thank you again.
Thanks, everybody. Nice to see some of you.